we're there to support. So thank you for the opportunity for us to come and share a little bit about independent pharmacy and owning a pharmacy, operating a pharmacy, and then growing a pharmacy. So we're excited to be here. So let's get kicked off. We're going to start off talking about, you want me to review the agenda?
Yeah.
All right. We're going to start off with me reviewing the agenda. We have welcomed you. And now we're at the review agenda part. So if I'd read that.
We did the introductions.
Yeah, we did introductions.
And we actually did speed networking. We've been
Yeah,
very
that was
efficient.
fast. That was fast. So we're going to start off with independent pharmacy market overview, and each of you should have a copy of the most recent NCPA Digest sponsored by Cardinal Health.
Does everybody have one?
Should have had that at your spot. If not, we'll make sure you get a copy. A lot of valuable information found in there for comparisons. Then we're going to talk about pharmacy ownership, and this 9:30, 10 o'clock is somewhat flexible. So we may spend a little more time on one than other. Then we're going to take a break and go over operating a store or stores, and then sustaining, growing your business, and then we'll have lunch and a panel discussion with our guests today, Q&A. So let's get started. So a lot of you talked about why you're interested in independent pharmacy and potentially pharmacy ownership. And so why step out of the box, big box retail chain? The ability to offer innovative patient care. I think I heard that several times as reasons that you might be interested. Make a difference in your community. I heard that, right? Rural community. I'd like to make a difference in my rural community. Run my business my way. I heard that a lot, right? You will have the opportunity to run your business your way and the third party's way and the way that you will have that opportunity. And start or continue a legacy. If you know anything about retail independent pharmacy, a lot of them are family owned, right? A lot of them are multi-generation family owned. I know that we have several customers who the grandparent maybe started that pharmacy and it sort of just hung in the family. Sometimes ownership changes and you get to restart the legacy with a new family. But it really is one of the exciting things, and what we get excited about is getting to deal with small business owners and real strong family atmosphere and a strong tie to the community. We know for a fact that when independent pharmacy leaves a community, the community suffers. The level of patient care is not the same. It just isn't. That's something to be excited about. Independent pharmacy today. So these are the most updated numbers we have from the NCPA Digest, sponsored by Cardinal Health. You will get tired of hearing that. Almost an $89 billion marketplace, annual sales. 92% of sales come from prescription drugs. By contrast, can you tell me, Walgreens, CVS, what those numbers are for Walgreens, CVS, prescription versus front end? Anybody have a guess?
80 to 85.
80 to 85? So it's more front end heavy than that. Anybody else have a guess? I would think 80. That would have been my guess, 80, 85. It's almost 60%, 50 to 60% is prescription. There are some stores where it is 60% front end, but their average is around the 50, 60% mark. So think about that. Maybe the key really is selling Christmas lights and lawn chairs. Maybe that's it. But there has been a new focus on being a retailer, especially in the chain space, rather than being prescription primarily. Which in our independents, we know it's prescription primarily, 92%. So by comparison, the market was almost $93 billion just 4 years ago. I'll come back to that in just a second. There's 22,800 independent pharmacies. It's down 250 pharmacies since 2010. So we know that most of our pharmacy owners are older, and we expect potentially half of the pharmacies to change ownership in the next 10 years. Think about that. There's 22,000, almost 23,000 pharmacies, and nearly half of those will probably change ownership or get passed in the family or something. There'll be some kind of change that happens in who owns, who runs those pharmacies. So there's a lot of potential for new owners and new life in some of our stores. So why do you think this changed? So the total market share, we talked about it being almost 89 billion. It's down from almost 93 billion. But it's not as a percentage, that's a way different number than 250 stores. So it can't be the fact that 250 stores aren't there anymore that drove this 4 billion change, because it's not proportional. So what do you think is driving that, based on what you know about pharmacy and what's happening in pharmacy the last couple of years?
PBMs.
PBMs? Reimbursements down? I hope that wasn't new news for you, or bad news. It's down. Why else? What costs more to buy and dispense, a branded drug or a generic drug? Branded costs more, right? But what has happened over the last 3 or 4 years very heavily? There's been a large branded generic conversion. Big blockbuster drugs that made a lot of money for a lot of people have gone to generic, and they've gone multi-source generic. So once you get 3 or more manufacturers, the price drops 92%. Acquisition price will drop. So does reimbursement, right? As a percent, it sometimes is okay, but if you look at the dollars sometimes don't follow. So the story here is not just the fact that the number of independent pharmacies is down 250. The story really is there's a lot of market industry dynamics that are happening on the buy side, on the manufacturer side, branded generic conversion primarily. An interesting thing, though, where this might start to change is on the generic drug side, we really are in a period of inflation versus a period of deflation. So over 70% of generic drugs today are in a period of inflation. So I'll throw you a softball. Tell me the difference between inflation and deflation. Who'd like to take that one? Anybody ever blown up a beach ball? Right? That's inflating it. You ever popped a hole in it? That's deflating it, right? So I don't have any fancy analogies. We're going to use things like beach balls and blowing stuff up. So generics are really in a period of inflation. We have manufacturers who are deciding that maybe we don't want to make that drug anymore. The market is pretty full. Let's go take our time, resources, and go try to make something else that nobody else is maybe making so we can try to make some more money. So you have manufacturers exiting. You have manufacturers buying each other up in the generics marketplace, as well as you have generic manufacturers who want to buy up all the raw material. And not only are they a supplier of the drug, but they also own the raw material, so they can determine who can make it and who can't. So there's a lot of dynamics that happen in the availability of generics as well as the manufacturers of generics. So again, I say all that to say this decline in dollars, we may see it either hold a little steady, or we might see it reverse course a little bit, depending on what happens in generics. Retail independent pharmacies employ over 220,000 full-time workers. Think about that. Full-time employment. Employment numbers are something that we hear a lot about. Time and time again, we also hear about the impact of small business to the larger economy. Retail independent does provide jobs. And growing number of multi-store owners. So more and more we're seeing people that maybe traditionally had that one store that they hung their shingle up on. They're now having multiple stores. Randy's a good example, right? Randy's now a multi-store owner. So the average is 1.71 stores. We have customers who own 9 or 10 locations. We have customers who own single locations. So it's all over the board, but more and more we're seeing, I wouldn't call it consolidation, but maybe ownership consolidation. Whereas these older owners are getting out of pharmacy. We talked about 50% of them are going to change ownership in the next 10 years. The existing pharmacies will sometimes buy those and continue to operate them. The average store, their sales, gross sales, total sales out the door, $3.9 million a year. How many prescriptions? A little over 62,000. It comes out to 200 per day. So that's what we see as the average pharmacy. The average retail independent pharmacy fills 200 prescriptions a day. Gross margin, 23%. All right. I'm going to use your whiteboard. Everybody know what gross margin is? Do we need to go over gross margin? Would it help to talk about gross margin? I think it'll help to talk about it. So you can ignore me or not watch. We're going to talk about it. So let's say your total sales were $3.9 million, right? I'm trying to write that large enough for everybody. $3.9 million. So if you've ever seen a financial statement, this would be on the income statement or the P&L, same document. This would be on the income statement. The top line on an income statement is always sales, right? We're sales guys. We love that word. Sales, right? Sales. The next line is always cost of goods sold. So this isn't what you bought. This is the cost of what you sold. Okay? See the difference? Cost of goods sold is not you just take all the invoices from all your suppliers and determine what you bought, because you probably didn't sell everything you bought. So it's the actual cost associated with everything that you sold. These two are related. So let's say you might have a calculator and want to do some quick math. 23% of 3.9 million, actually be the inverse, so 77% of that. I'll put it. A good presenter would have had this done already. So the cost of those sales, the cost of that product was a little over $3 million, according to that average. So this is 77%, right? Everything's as a percent of sales. Gross margin would be the difference. $897,000. I should have been able to do that in my head. $997,000. No, $897,000. All right. So that's gross margin. That's how you get gross margin. Sorry for my penmanship. So 23% gross margin. So after they paid for that inventory, what did they make? $897,000 for the average store. Well, how did they do it? Well, the average charge of a prescription, this is total, this is sales, so this is what third-party reimbursement would be, or if you had that mysterious cash customer, right, that really doesn't exist much out there anymore, the average sale of those prescriptions is $57.50. This is down. In years past, this number was 60, 63, 64. Again, conversion to generics is what's driving that. So we talked about how we go from sales to gross margin. And now we're talking about net operating income. So after you've paid for all that inventory that you dispensed or sold out of your front end, you have $897,000 left. What are you going to do with that? Well, you got to pay yourself. You got to pay the people that work for you or with you. And you also have to pay all of the expenses associated with it. So utilities, rent, insurance, all of those bills that are part of an ongoing concern of a business. You've got to pay for that. Plus salaries out of this $897,000. Plus your pharmacy system maintenance. You name it. Licenses. Anything else you want to do out of that business. That's what you've got to pay it out of. And when you've paid all the bills, the average store has a 3% net operating income. 3%. So that is, after everything's taken care of, everything's paid, that's what's left to either reinvest in your business or whatever else you want to do with it. Right? So that's what average pharmacy looks like. average independent pharmacy. So we're going to talk later about how you, at the end of the day, we're going to talk about new different ways that you can do something else to improve patient care that goes beyond filling the prescription. And a lot of times we talk about some of these items. We're not going to spend a ton of time here because we're going to talk about it at the end of the day, but different ways to do things. Compounding, the focus on MPM, which is now a critical piece of pharmacy, of retail pharmacy. Immunizations, looking into DME, specialty pharmacy, and what does that mean, right? That has a lot of different definitions right now. And then we have stores that are focused on specific disease states or specific initiatives. So skin care, weight loss, diabetes, heart health, all kinds of niche focused areas that pharmacies do. And then also a new focus on retail. We know what the chains are doing. And maybe as an independent pharmacy owner, you don't want to be exactly like a chain. But at the same time, a dollar's a dollar, right? And making $2 off selling a front-end item is a whole lot easier than sometimes making that same $2 on a prescription item, right? Because there's not a lot of incremental cost that goes into selling an over-the-counter item. You don't have a label. You get to sell it in the same box it came to your store in, right? You don't have to have somebody check it. There's not a lot of added labor you have to put on top of that to turn that into a sale. It's basically a simple transition from inventory to out the door. So don't discount, do not discount the value of the front end of a retail store. Well, we've already done that. No, we haven't. All right, so owners, how much do they make? So one of the big questions, specifically when you come out of pharmacy school and you may or may not have loans, you probably may, but maybe you don't. Maybe you got a rich uncle. Can I really do it? Can I really do it and pay the bills, and is there enough money in it for me? So we'll look at an example. We talked about the average pharmacy has $3.9 million a year in revenue, so that was our total sales number here. 200 prescriptions a day, approximately 10 full-time employees, including a working owner, and a net income between 3 to 9%. So we said 3% was average on NCPA Digest. Does anybody know how many stores report to the NCPA Digest, sponsored by Cardinal Health? I forgot it a minute ago, so I had to say it again, sponsored by Cardinal Health. So it's voluntary to participate in the NCPA Digest. Right now, there's less than 600 stores out of the 23,000 that provide data. Okay? So think about that. Is that a great sample size? It probably could be better, but it's all we have. It's really all we have. So I can tell you from seeing financials of store owners that 3% is a pretty conservative number. And there's lots of ways to get that number down, right? Because you don't pay, some owners don't want to pay a lot of taxes. So that number sometimes we add incremental expenses for stuff that maybe you wouldn't have an expense on as a new owner. Total annual earnings, average $245,000. That is the owner salary of $125 plus the pharmacy profit. So sometimes they take a disbursement out of the backside of those earnings. The top 10% of pharmacy owners earn $375,000. So here's the questions. I think a lot of you answered this question for yourself when we went around the introductions this morning. So some of these same questions, it sounds like you've already asked yourself, which is great, right? Means you're self-aware. It means that you really thought about what you're doing before you showed up today. So are you entrepreneurial? Well, what does that mean? Are you naturally curious? Do you ask a lot of whys? Why is this way? Are you intuitive? Are you persistent? Do you take chances? Do you have new and different ideas? I heard a lot of new and different ideas today. Do you keep New Year's resolutions? That seems odd. Even if you don't keep New Year's resolutions, you might be a good pharmacy owner. Don't let that rule you out. Do you rebel against authority? Right? I think the underlying question there is, does sometimes in your gut, you know that there's a better way to do something? I heard somebody on this side, thinking it was on this side of the room, say, I think there's a better way to take care of patients than the way I'd have to do it in a chain store. I don't remember. Did it come from over? Was it you?
I think it was me.
Yeah, I think it was you. I was pretty sure, but I didn't want to single you out. So I think there might be a better way to do it than the way the big box does it. Well, good. Follow that. Go do it. Go take care of a patient. Are you stubborn? I think that's pretty good, right, Scott? Most of our pharmacy owners are pretty stubborn sometimes, right? But you got to be that way. It needs to be. You need to know what you want, and you need to be ready to go do it, right? That's how you execute, right? They say, what is it? A dream without a plan is only a wish, right? Put feet to those dreams. Do you examine your mistakes and learn from them? Continually learning. Even when you leave here, you got to keep learning. Do things different. And do you enjoy being alone? That's a weird question, right? Some of you may say, I'm already alone. Some of you may say that is an odd question. It's an odd question, but the point of that question is really, sometimes as an independent business owner, even if it wasn't pharmacy, you sort of feel like the only one out there. But that's really what somebody who takes initiative and someone who wants to do something different, whether it's how you're going to handle and care for your patients versus, hey, I want to really focus on this disease state and lead the way on patient care here, you're going to feel alone for a while. That's what being an innovator feels like. Sometimes you're alone. Why now? So community pharmacy is strong and thriving. Baby boomers are aging. 60% of independent pharmacies will change hands in the next 10 years. Owners want to see their legacies continue. And their legacy isn't necessarily just their family name. It's what they've provided in that community. And if you have a relationship with that owner and you demonstrate that you're passionate about the same things that that owner is passionate about, the discussion of pharmacy transition is a whole lot, it's an easier hurdle to have, right? Like minds. Money is cheap. Borrowing money is cheaper than it has been historically. That's what that means. Are you thinking about owning a pharmacy? Is now the best time to buy a pharmacy? It's a great time. There's going to be more pharmacies for sale in the next 10 years than potentially there are buyers. That's a great position when you're trying to buy, right? It's like if you're trying to buy a house. If there's 300 houses for sale in your community, but there's only 10 people actively looking for a house, then you're probably going to get a great deal. So there's potentially turns into a buyer's market versus a seller's market. What is a pharmacy worth? We're going to ask that question. Do I need $1 million to buy $1 million pharmacy? No. No, you don't have to have all the money right at the beginning. Is financing available? Yeah, we'll answer those questions. So it's not without challenges. So think about what some of these challenges are. Managing 10 plus employees. Managing people, don't discount it. Managing people will probably be one of the harder parts of owning a business. Because you're managing individuals, you're managing personalities, you're managing behavior. And not everybody has your vision or drive for that business, right, Randy? So spoken as a real owner, Randy would know even more than me. So not everyone will share that passion. Not everybody's going to be 100% on board. Some people are there just to get that paycheck. You got to figure out how you manage those folks because they're probably key contributors, but they may not have a desire to do extra. How are you going to manage people? So any experience that you can get along the way, or anything you can read, get your hands on, or anybody you might know that already is a people manager, maybe somebody in your family, maybe in some of the stores you're working at. Maybe that's a great question to start asking. How do you manage people and personalities? That's a skill that is going to be needed. You are the CEO, CFO, CIO, CAO, CCO. You're everything, right? You're everything. You are the Harry Truman of the pharmacy. The buck stops there, right? You're going to be it as the owner. 14% of pharmacies operate at a loss. They do. Perpetually? No, it wouldn't be there for very long, right? But at any given year, 14% of retail pharmacies may operate at a loss. 1,000 close their doors each year. But think about that statistic we looked at a minute ago. In a 4-year gap, it only changed by 250 pharmacies. So if 1,000 close their doors each year, that tells me what? That not quite that many open their doors each year. Or there's some consolidation too. So it's not all a bad picture. 1,000 may close, but almost at the same rate. Not quite, but I guess the 75% rate, the same amount open up. Pressures on reimbursement. AWP, AMP, dispensing fees, Medicaid, all third-party things. We're going to talk about that today too. Healthcare reform, more access, but probably reductions in reimbursement. It's not probably, it's yes, reductions in reimbursement. So the path to ownership. So what's the right move? You have a lot of choices. Should I buy a pharmacy that's existing? Should I start a brand new pharmacy? What about a junior partnership? What about buying an investment pharmacy? Being newly into the pharmacy field when you graduate, unless you're just sitting on a lot of money and you don't have to work, probably we can roll out purchasing an investment pharmacy. You know, if you have unique circumstances and would like to talk about purchasing an investment pharmacy, we can certainly have that conversation outside. But we're going to focus on these first three, really. What's the easiest road to success, do you think, out of the first two? Junior partnership is sort of its own thing. I'm going to move it out. We'll talk about it separately. But between purchasing an existing pharmacy or starting up a pharmacy from scratch, what do you think is the easiest path to success and the easiest path to profitability? Purchasing an existing. Yep. Yep. Why? Pretty obvious, but why?
You already got the customers.
You already have customers, right? You can decide that you want to build a new one, right? You want to start from scratch, and people have been successful doing that. But it is much harder because you may have all the right programs, you may have an exceptional staff, you may have a snazzy logo, you may have everything that on paper would say, this is the pharmacy of the future, this is how we're going to take care of patients. But unless you get people in the door filling prescriptions and buying things out front, it doesn't matter. So it's really, really difficult. You have to have a lot of capital. You have to have a lot of patience. And you really have to have a lot inside of you to start one from scratch and be willing to weather that out. Is it impossible? It's not impossible. Given the right circumstances, it makes a lot of sense. But generally speaking, it's the hardest way to do it. A startup is a hard way to do it. There are different things, though, that can influence that. So a medical clinic, and you happen to get right in there and have pharmacies, right? So then you almost have patients right there. They have an irresistible inclination to walk into your store. That's different than, finding some property at the edge of town and deciding that the price is right, and I'm going to put my store in there, and if I build it, they'll come. They don't always come just because you build something great. So buying something that's existing is great, because guess what? If there's any improvements that need to be made, even if it's, let's say it's an average store filling 200 prescriptions a day. That's average. So if you buy an average store, you're filling 200 a day, you don't necessarily have to go chase pharmacy prescription growth to change the profitability of that store. Depending on the current ownership and how they're engaged with patients and what do their operational expenses look like, there's an opportunity there to really take a pharmacy that's performing an average and make it exceptional. You can come in and do some things that are really different in there that will one day improve script count, but right away will improve bottom line and profitability because you're going to own it and operate it differently. That's where the real upside is to buying an existing pharmacy. It's the things that you can go do differently inside that store.
Hey Josh,
Yes?
could we also just, maybe you could comment just a little bit on franchise as a route? Because
Yes.
I think that this doesn't necessarily bring that up, but that's almost, there's a little bit of a compromise or a middle ground between starting it up from scratch and purchasing an existing.
Yeah. So there is a franchise opportunity. So different folks have franchises. Cardinal's primary franchise vehicle is Medicine Shop, Medicat. So you get sort of a chain recognition. It's not a chain, but it's a nationally recognized name that you get to put on your store. And Cardinal just announced co-branding too. So in the past, you just were called Medicine Shop Pharmacy. If that's the route you wanted to go, you were called Medicine Shop. Cardinal has now, in the last month, announced a co-branding deal where it can still be Bob's Pharmacy, part of the Medicine Shop family, right? So you can still have that autonomy with, I want my name on the awning, on the side. I want people to know it's me. But I'm also part of a network of pharmacies. So there is that option there too. And what do you get with a franchise model? You get a lot of tools at your ready disposal starting off. You get coaching, you get a lot of assistance, you get a lot of comparative things. What are my peers doing? What is some advice? It's almost like having a formal super mentor is really what you get. Somebody that walks alongside of you and gives you real business advice and counsel along the way. So that's one of the benefits to franchising. Anything else I should add on that?
No, I think that's helpful because
Okay.
I work with a lot of people who are just wanting to get into ownership, and that really sort of the ability to have resources at your disposal is really important, and I'm excited that people can now do a Medicine Shop and have their name on it. So I'm actually working with a few startups right now who are looking at the Medicine Shop option. It just kind of makes it so that you have a little bit more resources at your disposal. I also have worked with pure startups where they're doing well, but oftentimes they have a very specific market. So maybe they are serving the Hispanic population and they speak Spanish. So that's kind of some of those things where startups can work, but you have to really do your homework. And I know you guys have NCPA here, your chapter. Doing the business plan is a really good way to kind of get your mind wrapped around what kind of a store could actually be viable as a startup.
Okay. So, big picture, the road to success is a little bit easier a whole lot easier buying an existing store. Startup's not impossible. It's more difficult. Requires a lot more patience. Requires a lot more money. It really does. Long term, it requires some money and some patience. Junior partnership. So a junior partnership is where you come in, you have a little bit of ownership to start in, or you have to work for a certain period of time to get some ownership, and then eventually you're aligned to. The hope is to buy the store by the end. So junior partnerships can work. They have been very successful in the past. You need to have a committed owner who is really committed to selling the pharmacy, not just a handshake agreement. You need really the terms of what that junior partnership is going to be. That needs to be spelled out. We have a lot of customers who had previously been in an informal junior partnership agreement where, I worked for him for 20 years. He always told me he was going to sell to me, and then one day he sold to the chain and never gave me the chance. So make sure that it's formalized, whatever your partnership might be, if junior partnership is the route you choose. That's the only, real caveat there. The other thing is that sometimes can be a more expensive way to eventually buy and own a pharmacy because you've got a lot of sweat equity that you've put into it. So let's take a scenario of 65-year-old pharmacist who may not be that interested in doing that much more than filling prescriptions today, and you go in under a junior partnership, and after 2 or 3 years, your sweat equity, you'll have maybe 10, 15, 20% of ownership, just making those numbers up. And then in that 2 or 3 years, you also increase the prescription count by 20 or 30% because of the innovative things that you brought to the pharmacy. Well, that pharmacy is now worth more than the day you started, right? It's now worth more. And you carried it on your back, and now when it's time to buy it, you may potentially have to pay more for it. So just understand that the financials that go into that sometimes will make the pharmacy more expensive to buy over time than buying an existing one up front. But what are the benefits to doing it? Because there's definitely some benefits. So you get to work alongside with the seasoned owner potentially, learn their best tips, best practices. Several of you may know some pharmacy owners that you'd love the opportunity to work with them day in and day out for the next 3 or 4 years, pick their brain, pick up all their best practices, learn those hard life lessons that they had to learn over 20, 30 years. Maybe you can pick some of those up and put some things in your toolbox pretty quickly. Save yourself the pain and frustration of having to learn some of those lessons firsthand. So there's a lot of benefits to a junior partnership. I don't want to discount it. I do want to say, though, that potentially, unless you have the right agreement in place, it can be sometimes expensive in regards to money as well as expensive in your time. Does anybody want to talk about buying an investment pharmacy? If you do, Chad Sanders, who typically does this presentation, and some of you may have been, I think Chad presented in the spring, this past spring here, so you may have come for Chad Sanders' pharmacy ownership presentation back in the spring. Chad Sanders is a great contact for all things buying and selling pharmacies. He couldn't be here because his schedule didn't permit today, so we can definitely get you in touch with Chad if you have more questions about what is the right path to ownership.
Just to say real quick, as far as the startup pharmacy piece, I know Josh mentioned that sometimes they take some time, but we have a lot of great success stories out there right now with pharmacies that have just started in the past several years, and they've really been successful. So startups a good way to go also.
Yeah, and the most successful startups, and I think that we have a recent example too there, the most successful startups are when you go in and replace a pharmacy. So sometimes a town may only have 1 or 2 independent stores, and it gets to the point where the independent just sells or closes up. The best thing that you can do is go put one right back in its place. You'll pull it back. All that business that the chains just tried to buy when they bought the files, if they had wanted to do business with the chains, they would have been there already, right? If the chain's already there. If given the choice, they had already made their choice. They were at the independent. You can sometimes go right back in that same town, that same community, and backfill a pharmacy that just left and really do well. And that's our startup pharmacies. Those, I don't know that we've had one that just didn't do great. They always do well. We had one that backfilled in this area, backfilled a location, and was able to go into the same exact location that the pharmacy that sold was in. Went into the same building, same location, new sign, and they hit break even on their script count in 2 months, which is unheard of. They were filling 80 prescriptions a day, 60 days in, which is, it's unheard of for a startup. There are startups that do that, but it's not typical. So after that, he started adding some long-term care business on top of his base retail business, and it was free and clear profit after that. So that's not typical, but that is a great success story. If you are going to do a startup pharmacy, the stars sort of align just right and perfect if you can go back in where one just was or was there in the last 6 to 8 months. And write your own success story. I'd like to be an owner. How do I do it? Come buy one. Right? So the average pharmacy sells between $800,000 and $1 million. That's not pocket change for me. It typically isn't for most folks. So do I need all $800,000 to $1 million to buy that store. Not necessarily. What do you need? Good credit. So all of those financial hard life lesson talks that maybe your mom or dad or significant person in your life tried to give you over the last couple years are meaningful. Good credit. You need to be generally you need to be a pharmacist. There are non-pharmacist owners, but generally you guys are all hopefully be pharmacists. Finish up, go all the way. You'll need some cash. We'll talk about that, but yeah, you need some cash. You need something. You need to bring something to the table. A burning desire to own. Don't decide to own a pharmacy just because you just thought it was a good idea. There wasn't anything else happening that day, so you decided you might want to buy one. You have to really want to own it. You want to own it. If you don't have the burning passion, it's going to be very difficult. It just will be. Your heart really has to be in it. This isn't a casual decision to own a business, and it's definitely not a casual decision to own a pharmacy. It takes some focus, and it takes a real desire to want to do it. And a good mentor. I don't think that we could emphasize the need for a good mentor enough. We could probably spend a lot of time in a separate presentation talking about the value of having a mentor. And it goes not just in pharmacy, not just as a pharmacy owner, but anything in life. Having someone who can sort of make sure you are staying within the guardrails and the way you're thinking and sort of harnessing the energy of your ideas, but keeping you grounded in that. There's a lot to be said for the value of a mentor. I have mentors in my life, professionally as well as personally, and I really couldn't put a value on that. Seek out now. Have those mentors in your life. Sometimes it can be faculty as a student, but there'll be other people along your life through the rest of your career that informal or formally will be a good mentor for you. Try to surround yourself with people that know more than you do about stuff. If you walk in a room and you're the guy who knows everything or the gal who knows everything, remember that question about do you like to be alone? You'll be alone. You'll be alone. Try to put people around you that you just know something that you don't know, and try to pick it. It'll take you a long way in being an owner, being a pharmacist. You have to have a plan. So we talked about, under the qualifications, good credit, a valid pharmacist license. You wouldn't think we'd have to put that up there, but sometimes we do. A desire to own a business. We talked about the burning desire. We talked about a good mentor. So that was from the previous slide. And then access and capital. How much equity? Do you have partners? Working capital. So sometimes you don't have to have $1 million to buy the $1 million pharmacy. You're going to borrow some money to do that. You may be able to put some sweat equity into it to do that. There's all kinds of different ways to get equity and build equity. You may have a rich uncle who is just dying for you to buy a pharmacy. That's an awesome experience if anybody gets to have that. But you have to think beyond buying and making that note payment on the store you just bought. There are operating expenses and reimbursement. You don't get paid the day that you fill the prescription. I wish you did, but less than 10% of independent businesses in cash prescriptions. Most of it is third-party reimbursement. And that can be insurers, PBMs, private insurers. It can be state Medicaids, Medicare. The average cycle on getting paid, and I know Scott is going to talk about this later, but it can take 2 to 3 weeks, right, before you get paid back for that medicine you just dispensed. But as soon as you dispense it, you've got to replace that inventory potentially. And when you replace that inventory, you've got to pay for it before you're ever getting paid for the dispense. So for example, Miss Jones comes in for her 9 prescriptions today, and I fill them all. And she takes them out, and they're all insurance. So I've ran them all through, I've adjudicated them through. I haven't gotten paid. I did pick up a little bit of a copay, but it nowhere near covered the cost of what I just dispensed. And now, today's Saturday, I've got to put an order in to replace that inventory for Monday. My wholesaler, probably Cardinal Health, is going to bring me a new order on Monday, and I've got to pay for that inventory well before I get reimbursed for those 9 prescriptions that I just sent out the door. So how do I do that? Well, you have to have working capital to do that. So as someone who has just bought a pharmacy who has a note, think of it as a mortgage, you have a note on that pharmacy where you're paying the bank or the previous owner, you're paying somebody for that. On top of that, and all of these other expenses that are below gross margin, remember that? Lights, water, insurance. I've got to have some money set aside to buy back my inventory. So you need working capital. You don't always get paid back the day before you need that dollar to turn it around. So working capital is something that sometimes someone who's really interested in buying a pharmacy, they understand this, they've got everything lined up, but they forget about that working capital need. And it really is, it's a big need. Maybe Cigna always pays you on Thursday, and Cigna's one of your largest payers in the pharmacy. But Thursday happened to be Thanksgiving. So Cigna decided that on those payments that week, they wouldn't send any payments out for 2 weeks. They just took a break because of the holiday. Give them credit, man. They're not trying to mess with you. Just running a business. But instead of getting paid this Thursday now for last 2 weeks ago, you're now going to get paid the following Thursday for 3 or 4 weeks ago. Do you see how that can disrupt your cash flow and cycle? So that's why there's an importance for working capital. You do have to have some liquid cash sitting there that you can pay some immediate needs, immediate bills that come up. Due diligence. So when you want to buy a store, the bank is going to ask for a lot of information. And whoever your wholesaler is also going to ask for a lot of that same information. You essentially, as a pharmacy owner who's buying a pharmacy, you have the loan from the bank, but also because you buy inventory every day for your pharmacy but pay every week or every 2 weeks, you also have a loan from whoever your supplier is, and you may have multiple suppliers. So tax returns, P&Ls, same as an income statement. So they'll need P&Ls, income statements, balance sheets from the existing pharmacy. We went over a couple ingredients of a P&L income statement here. Script counts, drug dispense, all of this information. Controlled substance usage, it's a big one we'll talk about later. All of this information is needed to sort of get going. Let's take a pause just for a second and see if there's any questions at this point. We've covered a lot of information, and some of it's really tightly connected, and some of it is sort of scattered around what we're talking about. So let's take a breather, and what questions does anybody have before we go any further? Yes, sir.
I'm just curious about the reimbursement for third parties. Do most pharmacies get checks in the mail, or is it direct deposit?
Okay. Direct deposit mostly, and we'll talk about some of the details on that and how, in particular, how Cardinal can help with that. But most of your third-party reimbursement is going to come electronically. Great question.
Come on, guys. I know you have.
I know it's early.
Do you determine working capital strictly off your script volume, or do other things come into that?
Our pharmacy ownership team, when they're helping people buy pharmacies, they also create an estimate for what the working capital needs should be for the pharmacy. And you can also get a lot of that information talking to the previous owner. I'll tell you, by and large, most of today's owners, the 60-plus age owners, there's not a lot of financial planning and preparation because when they started pharmacy, it was primarily a cash business. They were making 50% margin, which is 100% markup, on everything they sent out the door. Guys, you don't have to be a great operator in those circumstances. Do you understand? I'm not discounting our current owners, right? But the game has really, really changed, and you can't be a checkbook accountant, which is what I call it, right? So a checkbook accountant doesn't understand their cash flow cycle necessarily. They understand when there's no cash there, but they don't understand the cycle of it necessarily. They're not planning. A bill comes in, they open the envelope, they see what's due, they open the checkbook and go, I got enough money, I'm going to pay the bill, right? That's a checkbook accountant. So somebody who's planning has working capital set aside, they understand all that. So I say all that to say sales covers a multitude of sins. That's probably the best lesson I ever learned, is if you've got enough sales coming in the door, you can afford to do stupid. I mean, you just can. You can make bad decisions. They don't really hurt. And let's take it from a personal income level, right? So most of you all are students on limited income. Now, when you have limited income or limited sales, right, you notice if something costs $30 versus $10, right? So you're going to go eat out. You've decided you're going to go eat out. If you have a very fixed amount of money to spend, there's a huge difference between spending $30 from one person to eat versus spending $10 or the dollar menu, right? There's a difference. If money's not an issue, it doesn't really matter where you eat this week. You understand the difference? You can afford to do anything. You can afford to eat out 3 times a day, 7 days a week, and even put Starbucks in between, right? You could just do whatever you wanted to do if there's enough money. And that's really, for a lot of stores, that's what the 80s really felt like in pharmacy. 70s and 80s. You pretty much controlled your own destiny. As long as you could crank out a prescription, you knew that there was going to be money to cover all of the business expenses, as well as all of the hobbies and fun things that you wanted to do when you weren't working. That's not how pharmacy is today. Every penny matters, every decision starts to matter, and those decisions are layered on top of each other because they're all interconnected. So, being a checkbook accountant, you can't do that and be really successful, given the pressures from third party, the cash flow cycle in today's pharmacy, and the fact that you don't control what you were reimbursed. Reimbursement is not in your direct control. As an owner, as a pharmacist, you don't control much of that. So, any other questions? What questions?
The selling price you mentioned, is it based on number of prescriptions or based on cash and P&L? Because, like you said, it could be a bad owner and could show a loss on P&L, but they could fill 300 scripts a day, so...
Yeah. There are a number of ways to value a pharmacy. What we like to do is take a P&L and make some modifications, and we'll go over that in just a second. Script count, a lot of people use script count to value a pharmacy. There's a little bit of danger in script count. Script count, you have to build a lot of assumptions in there related to sales. What does the average prescription sell for? Anybody remember what that was? It was $56.50 or $57.50?
Close enough.
Pretty close, 57, right? We'll call it 57. But that number changes every year, right? So what number am I going to use when I value this pharmacy? What if it wasn't 56 for that pharmacy? What if it was 61? What if it was 42? Right? So having the right assumptions, if you're going to use script count, is really important. Plus, what are the costs of those prescriptions? And you don't know what their bill from their existing supplier is. You've got to know a lot more information. If all you have is a P&L, an income statement, then we can do some factors for goodwill. So we'll talk about that in just a second. I don't want to spill the whole beans, but that's a great question. After we've covered it, if you still have a question, ask me again. Any other questions?
So just a comment, so you guys, some of you may be thinking, oh my God, I'm not an accountant, this is crazy. I mean, and I can tell you, I didn't have any finance in school. I'm a journalism major. But you can teach yourself this stuff. It takes a little bit of discipline, but Finance for Dummies people, learn how to read an income statement. It's not impossible, and there's probably somebody in your life. I've had people who I've literally said, okay, this is going to make you think I'm totally an idiot, but I have no idea what SG&A is, and that was 10 years ago. Now I can talk to you about SG&A. So really, get together and make it fun. Get together and pick out a company. Go online, look at their income statement, and learn how to do this, because you guys can all do this. Don't let it be a deterrent to you that you don't like math or you're not good with numbers. If I can do it, you can do it.
Yeah, there's not any complex formulas here. It is multiplying, dividing, adding, and subtracting. And by the way, we also do a pharmacy finance module that we train internally that we could also, if there's ever any interest, we can definitely do pharmacy finance. We call it Pharmacy Finance 101, just because that's what we call it. What's the time frame to buy? The number one factor to slow down a motivated buyer is finding a store selling in a location they want, right? So we may, hey, I want to go back home and I want to have a pharmacy. And I want that pharmacy, I want Bob's Pharmacy on the corner. That's the one I want. Well, Bob may not be ready to sell, right? You may not have a relationship with Bob. He may be ready to sell, but maybe not to you. You might need to develop a relationship. Now would be a great time to be developing that relationship with Bob. If you have a very specific place in mind or a very specific store in mind, specific geography, not meaning like East Tennessee, but this town, a specific town, sometimes it's a longer wait for something to come up. It's no different than any other job, right? So if you say, for me, for example, I work for Cardinal Health. Cardinal has a lot of employees all over the country, all over the world. But if I want a long-term career with Cardinal, but I say I only want to live in Blount County, Maryville, Tennessee, I only want to live there, then it limits the opportunities. It limits how quick those opportunities become available, because you've now taken what might have felt like an infinite supply of opportunities. Cardinal has 30,000 employees, to now how many employees could Blount County necessarily support, how many opportunities are there. It limits it. So the more specific you are about your geography and your preferences for exactly the store you want, the exact store you want to buy, you start to limit a little bit of that opportunity. And if you're patient, and that's okay, then that's okay, right? But if you want to own a store within 6 months of graduating, you might consider opening up your focus. Once you locate the pharmacy, the process can take anywhere from 2 to 12 months, sometimes longer. It's really depending on the kind of information you have. Banks are going to need a lot of information to make their decision as they're doing due diligence processes. The buyer and seller, it may take time to come to terms of the agreement. What's it going to sell for? What's it worth? Is the owner going to finance any of it? How much? How long will that take? Working out all the pieces and parts of the agreement can take some time. We've had some turn and sell really fast. Sometimes it's a little bit longer of a process. So they're really unique in each way. There's no two transactions are exactly the same. And this is where we have a very strong team at Cardinal who helps sort of go through this whole process with you. And we're not brokers. Chad Sanders, who handles our area, he's not a broker. He doesn't get a commission off of the sale of the pharmacy. That's just a service Cardinal provides. We're trying to keep retail independent pharmacies independent. So it's a commitment that we've made. So what's involved in that 2 to 12 months? We talked about the due diligence, both by the bank, both by you trying to buy the store. Getting financing. You got to make an offer. You got to secure a lease agreement, right? If Bob doesn't own the store that you're buying, he's always leased it from someone. You now have to go renegotiate that lease as the new owner. And the bank wants you to have a long-term lease. They don't want to lend you money on a 2-year lease, right? Because your note is probably going to be longer than 2 years. They need to know that you're going to be there and the business is going to be viable for the term of the note. So you've got to renegotiate the lease agreement. and then negotiate transition. And if you buy real estate, if you buy the building and the property it sits on, that can also prolong the process, because valuing a pharmacy is sort of a, I don't know, it's like going to the barn and buying a horse, right? You kind of look the horse over and you got a number in mind and the seller has a number in mind, and eventually you come to agreements on a number. And then you got to get the bank convinced that that's a good number that they can loan money on. Real estate, though, is more of a tangible value asset than a pharmacy. So there's appraisals involved, all of that stuff. If you've ever bought real estate or have been involved with somebody who has bought real estate, that's just an extra layer, that sits on top of that process. Location, we talked about that. If you're very specific on a location, if you had to move the pharmacy, that all can just extend the time frame or shorten, depending on the circumstances. So you have to approach the seller. We talked about that. If the store, you'd like to buy the store, but maybe the store is not really for sale, or maybe it's not for sale to you, you may have to do some relationship building there and sell yourself before you can buy the pharmacy and get the owner comfortable that you are going to continue to serve the community. In some circumstances, that can take some time. The valuation process, lease, building the lease, coming up with your marketing plan, your business plan, all of that goes into all of that preparation. So it's not just, hey, let's go buy a pharmacy. I've got some money burning a hole in my pocket. Even if you have all the funds that you need to buy the store, there's a lot of planning that goes into it. You need to have a game plan, right? A dream without a plan is a wish. We said that earlier. Can you turn around? There's a cash cow, right? Is it something you're going to have to change the operations on? Or is this one of those that you just, it's a godsend, you walk in and it's just can't help but make money? I hope you find one of those, right? There's some out there. I hope the one you buy is that. But in case it's not, you need to have a plan. You need to know what your operations are going to look like. The negotiation of it, right? So what's involved in negotiation? Well, you have a term sheet. It's sort of, it's not quite as formal, but hey, here's what I'm buying. You know, this is what it's going to look like. This is what it's going to feel like. You get a letter of intent. Be a signature between two parties, and then the asset purchase agreement, which is the real buy-sell agreement. I think this is on a separate slide, but this starts talking about tax mitigation, real estate involved. Make sure that you have a good accountant that you can trust and is going to provide you sound counsel as well as legal advice. So a buyer should have their own legal representation, and a seller should have their own legal representation. Do not share the lawyer, okay? I know it'd be easier, things would go smoother, but those deals are usually one-sided. Make sure you got someone who is 100% acting on the interest of you, and that the seller has someone that is 100% acting in the interest of them. Makes good sense, but sometimes time pressure, and I got to buy it now, and I just would like this to be done. Sometimes people try to take a shortcut and make a silly decision there. Make sure that you, again, we talked about mentorship. Make sure you surround yourself with really good people. Mentors, accountant, lawyer. And then structure and obtain financing. So how can I finance a pharmacy? Well, sometimes the seller will carry part of the sale price. So if the sale price was $1 million, maybe the seller will carry 20% of that, and you can pay them off over 10 years. And then you can borrow some from the bank, and you don't have to put so much into it. In some limited circumstances, some of our banking partners will do 100% financing, but that can be a hard hill to climb sometimes. But even at that, you would still need what?
Working capital.
Working capital. Man, great answer. You'd still need working capital, right? You still need a little bit of money. In some cases, Cardinal will do matching. financing. We call it gap financing. And it's basically we'll match whatever you can bring in some circumstances. That all has to be pre-approved, both through our credit and finance department. Chad Sanders will be heavily involved in that, as well as our finance team. So let's say you're buying a store and you had a combination of financing. You had a bank note, but you also had the seller was going to carry some, and you were going to put $10,000 in. If you can put 10 in some cases Cardinal will match what you're putting in to help your equity position and give you another 10. It'd be on a note, you'd have to pay it back. But there is an opportunity sometimes in the right circumstances, depending on how the deal looks and what's involved. Cardinal can do some matching funds to help people buy stores. What questions do you have about this? I know we haven't answered the how do you value a pharmacy yet. We're getting there.
Does the SBA do loans on pharmacies?
They do. The SBA does do loans. An SBA loan is a longer process than a conventional bank loan. But we do partner with SBA lenders, and in fact, one of Cardinal's big partners is Live Oak Bank. They're an SBA lender. They do SBA loans as well. Your local banks sometimes do SBA loans. Sometimes you can get an SBA loan through a local relationship, but sometimes that can be a really long process. I have a store that's been going through an SBA loan process, not to buy a store, but just to secure additional financing, and it's been an 8-month process. You have to resubmit a lot of documents. You have to turn stuff in, and then if it's taking a little bit longer, they want it refreshed. So it's a lot of information that you got to pour into it, because an SBA loan is partially guaranteed, right? It's guaranteed by the federal government through the Small Business Administration. So there's like this big long guarantee, and because someone's sitting behind it and guaranteeing it, it requires even more paperwork than just showing that you have assets or collateral against your bank loan. What other questions do we have?
Going back to working capital, and you may discuss this later, so you can just do it again, but what all does Cardinal do as far as helping out with inventory at the onset?
Yeah, so if you buy a store, we'll talk about the calculation for buying a store. If you buy a store and you buy the inventory, then that's probably part of your note. So you technically have a little bit of working capital built into the way your deal was structured because you bought that inventory. For a brand new startup, or if you bought a pharmacy but didn't buy the inventory, we can do some help with opening inventory. And a lot of wholesalers do that. Cardinal definitely does it, but I don't want to act like we're the only ones who do it. That's one of the primary things that a wholesaler usually helps out with in helping us, especially a startup. And there's different terms, so many months you don't have to make a payment on that inventory, and then you have to start paying it off over time. Usually interest-free as long as you pay it under the agreement, the time. It might be 9 months, might be 10 months, maybe up to a year, but there'd be no interest attached to it. So it's almost free money, right? It's as free as it could get. What other questions do you have?
Would you approach a junior partnership the same way, like the same type of time frame, or the same type of, the same mindset, I guess, by doing these things?
The only thing is you got to be. I think you'd have to be careful. One, it'd have to be the right situation. Two, we'd want a very specific term and agreement. What's this junior partnership going to look like? But long term, when you think out of that too, you got to make sure that the owner's going to be receptive, because it doesn't matter who you are. If it's your dad's store and you're taking it over from your own dad, or if somebody totally different, whoever owns the pharmacy, whoever's buying the pharmacy, is going to do some things differently than the person who's selling it. And the seller needs to be reminded of that. So you got to be careful when you start talking about, here's my plans operationally for the pharmacy. I'm a junior partner. Here's what I want to do. Here's what I'm planning to do. You want to make sure that as excited as you are about the message that you want to deliver about what your plans are to turn the pharmacy around and what you want to do different, that Derek is as excited to be receptive. And we do have stores like that, right? Scott has a store today. Anytime we need to talk about anything, there's a guy who's going to sell the pharmacy, and there's a guy working there who's going to buy it. And we're already engaged with pharmacy transition. But anytime we're talking about something that has something to do besides filling a prescription, Scott is told, go talk to that guy. I don't do that, right? He knows the new guy buying it is going to do some things differently, and he's more interested in doing some of the patient care stuff than he is. At least he's recognized it. Some of the other, it just depends on the relationship. I don't think there's a hard and fast answer for your question. That was a long way to tell you that. What other questions? How are we on time? We've got about 10 minutes. 10 minutes? Okay, so let's dig in real fast. So the selling price includes goodwill, we'll get back to that, inventory, and accounts receivable. So account receivable is something that you've sold, but you haven't been paid for. So think about that as third-party reimbursement. That's your receivables. Used to, we really had to talk about charge accounts within the store. There are still stores that have charge accounts, but the dollars on those charge accounts compared to what we're talking about are usually pretty negligible. It's pretty tiny dollars. But if the store does have a receivables, if they have their own credit charge accounts for customers, that's something you want to uncover in your discovery part. Know what you're buying, right? Kick the tires. Make sure you know what you're buying. So you're going to buy receivables. Most of those, because 90% or more go through a third party, are going to be in third party receivables. So you need to have an understanding of what money's hanging out there that the pharmacy is owed at any given time. So you're buying the receivables. And you don't have to. So sometimes you don't buy the receivables. And this comes back to that working capital question. So it's not just inventory. Does somebody help me with inventory? That account receivable is really your working capital. It's sort of sitting there. It's going to trickle in. And if your script count stays the same or grows slightly, then those receivables should be within a few percentages the same dollars sort of over time that just continually trickle in. And that's your incoming cash flow. So from that, you should be able to pay your expenses and ongoing things. If you do not buy receivables, you're going to have a 3 to 4 week gap where you don't have any money coming into the pharmacy. So that means that your working capital need is now greater. You need to have more money on day one to own and operate the pharmacy. If you don't buy receivables, and I can see doing it both ways, then you need to borrow more money or have more money in your pocket on day one to cover those operating expenses for the first 60 days or so. Probably be a good ballpark number. And how would you know what the operating expenses are? Well, in your due diligence discovery while you're buying the pharmacy, you looked at those pharmacy financials and you have an understanding of everything that's below this gross margin line of what those expenses are. The bank generally will loan up to 80%. You need 20% of equity. And that can come in different ways. It doesn't mean you have to have 20% of the sell price in cash on day one. Sometimes they consider owner financing if the owner will carry a portion of the loan and let you pay them. Sometimes that's considered equity. Any money that you bring to the table, as well as if in certain circumstances if Cardinal matched what you were bringing to the table. The example we gave earlier was if you had $10,000 in cash that you were bringing to the sale and Cardinal matched that $10,000. So all of that's considered equity in a pharmacy sale. That's how you can get that 20. So I hit the next line. That's the balance is funded. The rest of that 20% is a combination of things. Let me see. Okay, we'll cut in here. Where do you get money? Banks. The seller carries a note. An SBA preferred lender. All kinds of different financing. I'm not an expert in pharmacy financing. our pharmacy transition services team, they are experts in pharmacy financing, and they can match you up with a lot of lending relationships that we have with different banks and financial institutions. So I'm going to throw that out there and not pretend that I'm an expert on financing a pharmacy. So I think it would probably be more worth our while that if you have in-depth questions on how to borrow money or seek money to buy a pharmacy, I should really refer you back to Chad Sanders. You don't want to get lending advice from me on buying a pharmacy. I'd probably give you some advice, but you might want to hear it from 2 or 3 more people before you took just my advice on it. Know your limitations. That's probably another lesson we ought to cover in here. Know your limitations. Personal loan from friend or family, right? Rich uncle, wealthy grandmother, whatever. Or you could raise capital. That's pretty rare to create an investment group and go get investors to go buy a pharmacy. Probably larger scale, multi-owner. That's more common. But for most of us in this room, that's not going to be the first pharmacy you buy. All right, role as a buyer. Convince a seller you can operate their legacy, right? I'm not going to trash it once I bought it from you. Convince a seller that you will take care of the customers and employees. Convince a seller you can obtain the funds necessary to purchase and execute a non-disclosure agreement. Non-disclosure agreement is basically a privacy guarantee between the two of you. The negotiations and the dealings in between is going to be confidential, and that they're not out there talking about who's buying their store, the terms of the agreement, and you're not out there talking about the store you're going to buy and the terms of that agreement. All right, so we've got 3 minutes. Okay, we're going to talk, it might take 4 minutes, but we're going to talk about valuing that pharmacy. So the 3 things we talked about, let's assume that we're buying receivables. What does the third party owe the pharmacy? Inventory, which are tangible assets, right? Prescriptions, the prescription medicine sitting on the shelf, as well as OTC product, any of that stuff that can be resold. And goodwill. Goodwill is the hard thing to value because it's not necessarily tangible. It's what's the business worth outside of the physical inventory I can put my hands on. We know inventory. You can decide whether you want to pay dollar for inventory or some kind of factor. Not all inventory you buy can be resold, right? So maybe you want a factor on that inventory. How are you going to value the inventory, right? Whose price file are you going to use? Those are some questions and considerations. But things like receivables, most of the receivables that are current, anything that's within 60 days, most of those are going to be paid dollar for dollar. So that's pretty much whatever's owed goes in. The goodwill is the difficult part. The goodwill is where the disagreement can occur on value in the pharmacy. So it can be based on script count. You can take script count, take a factor on script count. We talked about what some of the dangers are in doing that, right? You got to make a lot of assumptions on script count. And just because script count is that doesn't mean it'll be that tomorrow. So what Cardinal likes to do is we like to take the income statement and we like to go all the way below the expense line, right in front of net income. Before you pay taxes and depreciate any assets, we use a line called EBITDA. Has anybody ever heard this one before? You may have just heard EBIT. Has anybody seen that before? I'm going to trip over the wire. Earnings, it's just an acronym. Earnings before interest, taxes, depreciation, amortization. It's really after you got to your gross margin and you paid all your expenses, right before you pay taxes, that line. And generally, we see stores sell the goodwill between 3 times and 3.5 times the EBITDA line, plus inventory, plus accounts receivable. But there's a lot of information between gross margin and the EBIT line that you potentially need to make adjustments to. So for example, you may go find a pharmacy that you'd like to buy, and when you drill into the financials, you realize that there's 5 members of the family who get a salary from the owner, but they've never worked a day in their life in that pharmacy. That's now in the labor expense line. Well, when you buy the pharmacy, please don't continue to support the people who do not work there, right? So you can take credit for that cash. You can add that back, right? So when we value a pharmacy, we have to do those kind of massaging adjustments to true up the financials. What would these financials look like when you own the store, right? Maybe they have 4 company cars that all happen to be Mercedes, right? That's probably not going to be your delivery vehicle of choice. And probably the owner owns them all. Wink, wink, right? The store probably doesn't count those as assets. So any of those add backs that you can take out, we have to take those out and adjust that financial statement to get to the true EBIT line. They may be paying for multiple family members' health insurance. They may have some special draws coming out of the store. So you're looking for anything that would not be a continued expense as part of your operation. Once you identify those, that's why due diligence is really, really important. Understand what you're buying. Once you get to the true line there, then you kind of know what you're buying, and we can do factors and figure it out off that. And that's a starting point. So that's how we like to value goodwill. And it includes everything. So that goodwill line plus inventory plus accounts receivable come up to the purchase price, and when you buy that, that should include, in that scenario, anything the third party owes the store on the day you buy it, all the inventory sitting on the shelf, all of the fixtures, the cash register, the POS system, the pharmacy system, everything in there, unless they specifically call it out and say you're not buying this in the buy-sell agreement. All the assets of the business become yours under that scenario. And that's what you're taking to the bank. That's the purchase price you're negotiating. Once you get it, that's what you're taking to the bank saying, I want to buy it. This is what I'm going to pay for it. Here's how I'm going to pay for it. That's where your business plan comes in. You got to have one. Here's how I'm going to pay for everything. And that's it. That's it. I think I'm right at time. There's one more slide. I'm going to borrow a couple more minutes. How does this work? That's the slide I wanted to make sure that we hit. So in this scenario, the selling price is $1.3 million. This is slide 23. I skipped 1 or 2 slides, I think, in your book, but I basically talked about it already. So this store sold for 1.3. How did they get there? Well, they valued goodwill at a little over $751. The inventory was over $300,000, and the receivables due from third party were $247, $248. It added up to 1.3. Everybody agreed. That's what I'm paying. That's what I'm selling for. We have an agreement. Let's go to the bank. $200,000 equity up front for goodwill. That's roughly 25% of the goodwill price. So in this scenario, the buyer brought $25,000. The seller carried a note for $175,000. Right? So you didn't borrow all the 1.3 from the bank. It's hung out here. So the bank loan is 1.1 over 10 years. So how does that work? How could I buy a store? I only brought $25,000 to the table. That was all I brought. I just bought a $1.3 million store, and I owe the bank $1.1 million. How can I make that work? So real quickly, we're going to look at this slide. So the cost of that note is going to be $167,375 a year. That's what you're paying the bank. The EBIT line from the financial said that it's generating, after I pay all expenses, $250,000. So the bank is concerned about a debt service coverage ratio, which is basically taking that divided by that. What are the earnings out of the business? Divided by what's the debt. So what does this tell me? It says that in that year, I could cover my debt 1.5 times by my earnings. You want that number above 1, right? And it's far away positive that you can get from 1 the better you are. The closer you get to 1, that's when the lender at the bank starts to get nervous and wants to ask you for a lot more information. And then they really start looking at your business plan. And then if you fall to 1 or below 1, that's when it starts to become a no-go, because you can't even cover your debt. Okay, I know we're about 5 minutes over time, so I apologize for going over, but I needed to cover that. We'll take we're at break time?
Yes, we are.
We are at break time, so when do we want to come back, since I went over? Same time?
Let's see here. Why don't we come back at 10 to 11, so 10:50.
10:50.
Okay.